Today's session is on understanding of RBI and its functions. The full form of this acronym RBI is Reserve Bank of India. The banking industry, unlike other businesses, is a regulated industry because banks deal mainly with public money. This is why banks need to be regulated, and we have, in our case, Reserve Bank of India as the sole banking regulator. The Reserve Bank of India, empowered to be the Central Bank of India, was established in the year 1935. Therefore, the Reserve Bank of India acts as the regulator of banking system. That's it oversees, or in other words, acts as watchdog of the entire banking system in India. The Reserve Bank of India has its headquarters in Mumbai, the financial capital of India, and its regional offices are spread across all major cities in India. Now onwards, we shall use RBI to mean Reserve Bank of India in our discussion. First of all, let's begin with understanding what a central bank is. At some places of the world, central bank is called Reserve Bank, like we have in India. Similarly, somewhere else, it's known as Monetary Authority or National Bank. For instance, in our neighboring country, central bank is called as National Bank of Pakistan. In China, central bank is known as People's Bank of China. In Bhutan, central bank is called Royal Monetary Authority of Bhutan. Similarly, in Brunei, it's called Monetary Authority of Brunei, Darussalam. Americans know central bank as Federal Reserve. So we have different names, but the role is similar everywhere. These central banks act on government's behalf as banking regulators. As regulators, they have the mandate to manage a state's currency, money supply, and interest rates. Do you understand now why currency notes in India are issued by the RBI? You may be also thinking so far why RBI frames the policies or acts as policymaker in the money market. This is just because they have authority to do so in capacity of being a central bank in India, right? RBI no more decides the interest rates for banks in India. Nevertheless, it uses different monetary policy tools in the form of changing of policy rates and open market operations to influence the general level of interest rates in the market. Another purpose of central bank is that they are meant to regulate the functioning of commercial and other types of banks in their respective countries. In other words, central banks act as match referees in the banking system by setting the rules of the business and then ensuring that everyone follows them in letter and spirit so that banking system as a whole are safe and resilient to any failures or shocks. Apart from these functions, central banks also help their respective governments in their borrowing activities. In most cases, central banks issue securities on behalf of the government and then ask banks to subscribe for them. So that was an introduction about the central bank. You know, we recently understood commercial banks and their role. Now, to gain more clarity about the central bank, let's compare central bank with commercial banks. On your screen, you can see the features of central bank are put in contrast to features of commercial banks. On top of the points of distinction between the two, we can see that a central bank is the apex institution and all other banks, including commercial banks, are subservient to it. Then we also note that central banks enjoy monopoly of note issue, whereas commercial banks are not authorized to print any currency. Another distinction between the central bank and the commercial banks is that central bank is generally a not-for-profit institution, while as commercial banks have profit motive to operate. After this, we observe that central banks are custodians of foreign exchange reserves of a country, while commercial banks buy and sell foreign currency as per directions of the central bank. Lastly, the central bank acts as banker and advisor to sovereigns, while as commercial banks act as bankers and advisors to the general public. So that's how central banks differ from commercial banks. Now we have better understanding about what a central bank is. Now I ask you a question. Do you know why central banks rule over all other banks in the system? Is there any rationale for such a role or mandate of central banks? Of course, there's a strong justification, and let's see what's that. We know already that power to print currency notes is vested with the central banks everywhere. When central banks issue currency notes, these notes ultimately end up in the hands of banks as deposits. Then, with these deposits, banks create more money in the form of credit. If the stock of currency and credit in the system is not controlled, then the whole economic system will get disturbed because there will be no check on changes that happen in general level of prices of goods and services in the economy. The economy will really get into a bad order. So that's why central banks can't afford to leave other banks to be self-regulated like other types of businesses in the economy. In this segment, we shall go through evolution of central banking in India. That's we will see how central bank or RBI that we have today has evolved over past. Now you can notice on your screen that in year 1934, Reserve Bank of India Act was passed to pave the way for setting up of a central bank in India. Following this, RBI as India's central banking institution was founded on April 1st, 1935 to respond to economic troubles after the First World War. In the beginning, the central office of RBI was established in Calcutta, but later on it was permanently moved to Mumbai in 1937. The central office is the place where the governor sits and where various policies are formulated. Initially, when British government set up RBI, then it was privately owned, but since 1949, it's fully owned by the government of India. So that was how RBI has progressed through different stages over past. Now let's understand organizational structure of the RBI. On your screen, you can see that it has three layers. On top, there is central board of directors. Then at second level, there are local boards, and at the bottom, there are different departments. Let's understand each layer in more detail. Here is composition of the Central Board of Governors, which represents first layer of the RBI organizational structure. This is the level to which organization and management of RBI is vested with. That is, it is responsible for management of the RBI. The Central Board of Governors comprises of 20 members that include one governor at the top, followed by 4 deputy governors and 15 directors. The governor is the highest authority of RBI. He is appointed by the Government of India for a term of 5 years, which is then extendable to another term of 5 years. Similarly, 4 deputy governors are nominated by central government for a term of 5 years. Then 15 members of the central board are appointed by the central government. Out of these out of these 15 members, 4 directors are appointed by the government, being one each from the 4 local boards. Now I ask you a question, and that's, do you know who heads the RBI at present? If you do not know, then I may tell you that the present governor of the RBI is Mr. Shakti Kanta Das. He is RBI's 15th governor. Before him, it was Urjit Patel, who headed RBI, and prior to Urjit Patel, Dr. Raghuram Rajan, the famous economics professor, had been the governor of the RBI. So that was the brief sequence of the men that headed the RBI in the recent past. Next, we see the composition and domain of local boards. In all, there are 4 local boards, and their headquarters are located at 4 different zones like Mumbai for Central Zone, Kolkata for West Zone, Chennai for South Zone, and New Delhi for North Zone. These local boards consist of 5 members each that are appointed by the central government for a term of 4 years to represent territorial and economic interests and the interests of cooperatives and indigenous banks. These regional local boards are meant to advise the central board on general and specific issues referred to them and to perform duties which the central board delegates to them. Then we talk about the departments that operate at bottom level of overall structure of the RBI. There are 33 departments that have been given different mandates. For example, there are departments for supervision, currency management, payment and settlements, foreign exchange, monetary policy, etc. These departments are responsible for various functions and internal operations of the RBI. These are the subsidiaries of the RBI. These subsidiaries help RBI in rendering its various functions. For instance, DICGC, or Deposit Insurance and Credit Guarantee Corporation, is meant to provide insurance cover on deposits of commercial banks. Therefore, this subsidiary helps RBI to extend a safety net over commercial banks. Similarly, Bharatiya Reserve Bank Note Mudran Private Limited is the subsidiary that looks after printing of currency notes. Similarly, there are other subsidiaries that you can see on the screen, and each has a separate role. This is the preamble to the RBI Act of 1934. The preamble stands for the introduction or preface that is written at the start of a manuscript. This preamble describes the main functions of RBI that include to regulate issue of banknotes and maintenance of foreign exchange and other reserves for the purpose of securing monetary stability in the country. In addition to these, RBI has also mandate to manage the currency and credit system to the advantage of the country. In terms of the preamble that we just saw, we can list functions of the RBI in the manner as shown on your screen now. So what are these functions? From top, these functions include bank of note issue, banker and advisor to the government, lender of last resort, clearing agent, controller of credit, and custodian of foreign reserves. We shall understand each of these RBI functions in more detail now. Now let's take up first function of RBI, that's Bank of Note issue, for discussion. The RBI, by virtue of being the central bank in India, is the only or sole bank that is vested with the authority of printing currency notes. No bank other than RBI is allowed to do so. Therefore, RBI has got exclusive authority to issue currency notes. These currency notes include all currency notes of any denomination, but except 1 rupee coin and currency notes. But why 1 rupee currency note or coin is excluded? We will find answer to this question later on. The currency notes that are issued by RBI are its liabilities. Because if you look at any currency note, you can find that it bears a promise by RBI. So that makes currency notes issued by the RBI special promissory notes. The law requires RBI to maintain a minimum amount of 2000 million rupees as reserves in the form of gold and foreign currencies. At the begin of the current month, that is December 2020, RBI recorded a total of about 580 billion US dollars as its foreign exchange reserves. These are the reserves that are meant to support liabilities in the form of currency outstanding on the books of RBI. Now we try to find answer to our previous question, and that is why RBI is not allowed to issue 1 rupee coins or currency notes. Such currency notes and coins are issued by the Ministry of Finance in India. But why can't RBI issue them? The answer is that 1 rupee note or the coin defines the basic unit of the currency. So it is the base of the currency system. Moreover, unlike other currency notes, no promise is mentioned on the 1 rupee currency note. So that makes 1 rupee currency note an asset, just like other coins, and not the liability. Imagine the text that a 100 rupee note reads on its face when you look at it. It says, I promise to pay the bearer the sum of 1000 rupees. The sum of 100 rupees. Hence, RBI notes that or a liability promise to pay you an asset. This asset is defined by 1 rupee, right? This is the reason why RBI cannot issue 1 rupee notes and coins, and we have Ministry of Finance that issues them. The second function that RBI does is that it acts as a banker, advisor, and agent to the central government. By being so, RBI maintains the accounts of the central as well as state governments. Moreover, under this domain, RBI receives deposits from governments, makes short-term advances to them, collects their checks and drafts deposited, and also provides foreign exchange resource to them so that they could repay external debt or else purchase foreign goods, etc. Also, by being a banker to the government, RBI collects taxes and other payments on their behalf. As an advisor to the government, RBI advises the government on matters related to economic, monetary, financial, and fiscal issues such as deficit financing, devaluation, trade policy, foreign exchange policy, etc. So that was how RBI acts as a banker, agent, and advisor to the government. Of course, a government would also require banking services, as we all do need. So that's what RBI does for the government. Another important function performed by RBI in the system is to act as lender of last resort. When when does RBI act as a lender of last resort? This is especially when commercial banks fail to get money from their traditional sources. When markets dry up and when liquidity in the markets disappears, for example, there are occasions when banks are not willing to lend money to each other mutually out of fear of some uncertainties. Then at that time, banks that want to borrow can turn to RBI and seek funds by availing rediscounting of their bills and other securities. So this is how RBI acts as a lender of the last resort that banks can approach for funding in the times of distress or urgency. Now let's look at various benefits that arise when RBI extends its lender of last resort option to banks in the system. One of the advantages that banks can have due to this is that they can carry on their activities with limited cash reserves and assume higher risks consciously, because in the event of any distress, they may get funds easily from RBI, being their lender of last resort. Therefore, banks feel that there is a backup from the RBI. so they should not worry about their liquidity. In return, this function enables RBI to exercise control over the banking system of the entire country. Now we shall grasp one more important function rendered by the RBI, and that is RBI's function of being a clearing agent. Now we know that RBI is the apex bank that extends banking facilities to all other banks. Every bank has their current accounts with RBI. When that is the case, then RBI can easily settle the claims of various banks against each other with least use of cash through clearinghouse function. RBI also provides electronic clearing and settlement services between banks for their remittance claims through its RTGS and NEFT platforms. These two remittance or payment platforms are owned and managed by the RBI. Now we also need to know the advantages of the clearing function. This function leads to two advantages, one each for commercial banks and the central bank. And what are these advantages? With the help of clearing facility, commercial banks would require fewer withdrawals of cash, and hence it can help them to create credit on large scale basis. The clearing function also makes central bank to remain fully informed about the liquidity position of the commercial banks in the system. So these are the benefits of clearing function of the RBI. Another function that the central bank performs in India is control of credit. To understand this function, we need to learn first what is credit creation. Banks have the power to create and multiply credit, which is another kind of money present in the digital form. It's not the central bank money that they print, but this money has the same purchasing power that real currency has. To understand this phenomena, suppose you have both a debit and a credit card. With these cards, what can you do? It is very simple. You can shop, or in other words, they lend you purchasing power. But there's a difference. With the debit card, you spend your own savings. However, with a credit card, you shall be spending credit given by your bank. That's what real money and credit means. Now let's understand how do banks create money out of the thin air or out of nothing. In other words, how do banks create credit? We know that banks accept deposits from public and lend it back while keeping a certain amount as reserves with the central bank. The reserves are important. If some of the customers withdraw money, then the bank might pay it out of the reserves. In most of the countries, reserve amount set by the law is 10%. But in India, reserve is more than that. It is about 20%. So the rest of 80% is excess reserve, and the bank is free to loan it out, right? With this amount of reserves, let's see how banks in India create credit. Suppose that there is a customer A and he goes to bank 1 to deposit 100 rupees. Now as per policy, bank 1 keeps 20% as reserves, that's 20 rupees as reserves, and loans out 80 rupees to customer B. With this, there are now 180 rupees into existence. That is 100 rupees of the customer A and 80 rupees of the loan given to the customer B. This process doesn't stop here. Now customer B spends these 80 rupees, and the shopkeeper from whom customer B made purchases deposits that amount of rupees 80 in bank 2. Again, bank 2 keeps 20%, that's 16 rupees as reserves, and lends out remaining 64 rupees to customer C. In the second step, 144 rupees come into existence, which is 80 rupees of customer B and 64 rupees of customer C. Now customer C purchases something with 64 rupees, and the seller deposits the amount of sale, that's 64 rupees, into bank 3. Now bank 3, after setting aside a reserve of 20% of this deposit, that's 13 rupees, lends out remaining 51 rupees to the customer D. This process gets repeated again and again, and theoretically runs until infinity, right? This is how new money or credit is created by the banks. Using money multiplier function, we can ascertain how much credit banks in India can create out of an initial deposit of 100 rupees if there are 20% reserve requirements. To find that out, we will simply divide 100 by the reserve fraction, right? Therefore, in this case, banks would be able to create 500 rupee of total money, out of which 100 rupee is the real currency and remaining 400 rupees represents the credit, right? Now you can easily understand how central bank or RBI can control credit by changing reserve requirements. Using this money multiplier function, you can easily note if reserves are increased to 25%, then 100 divided by 25 becomes 400. Hence, by increasing reserves, total money in the system comes down. Similarly, if reserves are decreased to 15%, then 100 divided by 15 becomes 667, 667. Therefore, by decreasing reserves, total money in the system goes up. So that's how it works in the system there. Now you would have got why central bank needs to control credit. The controlling of credit is necessary to keep general level of prices in the economy under control so that there is no unwanted inflationary problems. The central bank or the RBI in our case can do so by either changing the policy rates or else by directly buying and selling securities from the money market. By changing the policy rates at which they lend and borrow money to and from commercial banks, RBI would control the supply of money and thereby the resultant supply of credit in the system. Similarly, by conducting open market operations of buying or selling of securities, it directly pumps in or sucks out money from the system so as to influence supply of credit. So this is how RBI controls supply of credit in the banking system. These are the additional measures that RBI can exercise to control supply of credit in this banking system. For instance, imposing of reserve requirements on banks like CRR and SLR that we discussed already, right? Qualitative and quantitative restrictions by advising banks where to and how much to lend, and also by the system of licensing, inspection, and calling for information. These are the various monetary policy tools of the RBI that are grouped into quantitative and qualitative categories. For instance, under quantitative category, we have policy rates like bank rate, repo rate, etc., open market operations, and regulation of reserves like CRR and SLR. Similarly, under qualitative category, there is imposition of margin requirements in lending, regulation of consumer credit, rationing of credit, direct action, and moral suasion. Finally, RBI as the central bank acts as the custodian of reserves of foreign currencies in India. Besides this function, RBI has also responsibility to maintain the official rate of exchange in India. This they do by setting the policy for determination of exchange rates and also by ensuring stability of exchange rates in the market. With this, we reach conclusion of today's discussion on Reserve Bank of India and its role in the financial system.